issue of U.S. tariff revenue is becoming a significant factor in the American economy, but its impact is far more complex than a simple measure of government income. Recently, the U.S. has seen a dramatic increase in the money collected from customs duties. For instance, in the first half of 2025, the US Treasury recorded over $87 billion in tariff revenue, surpassing the $79 billion collected in the entirety of 2024. This surge is a direct result of aggressive trade policies, including new and higher tariffs on goods from countries like the EU and China. However, this increased revenue is not a straightforward profit for the US. The money collected from tariffs is essentially a tax on imports, which is paid by American businesses. These businesses often pass the increased costs onto consumers through higher prices. This can lead to inflation, which reduces the purchasing power of American households. For example, some economists estimate that the current tariffs could result in an average income loss of thousands of dollars per household annually due to these higher prices. The general state of the issue is one of trade-offs. While the tariffs have boosted government revenue, they also have broader economic consequences. They can lead to retaliatory tariffs from other countries, which hurt U.S. exporters, particularly in the agricultural and manufacturing sectors. The tariffs also inject uncertainty into global supply chains, making it difficult for businesses to plan and invest. Ultimately, the debate over tariffs is a balance between the perceived benefit of protecting domestic industries and the real costs borne by consumers and exporters. The main cause for the significant increase in U.S. tariff revenue is a shift in trade policy toward a more protectionist stance. This has led to the implementation of new and higher tariffs on a wide range of imported goods from numerous countries. The trade deficit and domestic manufacturing. A primary driver of this policy is the desire to address the U.S. trade deficit. The argument is that tariffs will make foreign goods more expensive, thereby reducing imports and encouraging both American consumers to buy domestically produced goods and companies to move their manufacturing operations back to the U.S. The goal is to revitalize domestic industries, create jobs, and correct what the administration sees as unfair trade practices by other nations. Geopolitical and diplomatic leverage tariffs are also being used as a political tool for negotiation. The U.S. government has used the threat of tariffs to pressure trading partners into making concessions on issues beyond traditional trade. For example, tariffs have been linked to demands for other countries to address issues like illegal drug trafficking and border security. This approach uses economic pressure to achieve foreign policy objectives. Raising government revenue. A third reason, though often secondary to the others, is that tariffs serve as a direct source of government revenue. The money collected from these duties goes to the U.S. Treasury. While the tariffs are intended to change trade behavior, they have also become a notable source of income for the federal government. This revenue can then be used to fund other government initiatives, or, as some argue, to offset tax cuts. The most direct and tangible result of the recent increase in U.S. tariffs is a dramatic rise in government revenue. The U.S. Treasury has reported a significant surge in customs duties, with projections suggesting that the total collected revenue could be a record-breaking amount for the calendar year. This financial inflow provides the government with a new source of funds that can be used to finance various federal programs or reduce the national debt. Advantages. One of the primary perceived advantages is the protection of domestic industries. Tariffs are designed to make imported goods more expensive, which in theory encourages consumers and businesses to purchase domestically produced alternatives. This could lead to a revitalization of industries like manufacturing and agriculture, creating jobs and strengthening the U.S. economy from within. Another advantage is the leverage in negotiations. The threat of imposing or increasing tariffs can be used as a powerful tool in international relations to pressure other countries into changing their trade practices or to address non-trade related issues such as border security or diplomatic positions. However, it is crucial to recognize that these advantages are not without significant consequences. While the government sees a revenue increase and domestic industries may see some protection, the costs of these tariffs are largely borne by American businesses and consumers through higher prices and reduced purchasing power. The prediction for the US-Canada trade issue is that the current state of heightened tension and uncertainty will likely continue, with a swift resolution being highly improbable. President Trump's recent move to link Canada's foreign policy on Palestine with trade negotiations introduces a new, non-economic barrier that complicates talks. Canada's Prime Minister Mark Carney has stated that the country will not accept a bad deal, indicating a willingness to withstand U.S. pressure rather than concede on core principles. This suggests a prolonged period of negotiation, possibly extending beyond any new deadline set. The next step is for both sides to continue these talks, likely without an immediate breakthrough. Canada will likely seek to de-escalate the situation by engaging in further diplomatic dialogue and potentially exploring the formal dispute settlement mechanisms within the USMCA. Meanwhile, the U.S. administration will probably continue to use the leverage of tariffs to push for its demands on both trade and non-trade issues, such as fentanyl trafficking and border security. In the near term, we can predict that Canadian businesses will have to cope with the newly imposed tariffs, which will likely lead to increased costs and supply chain disruptions for products not covered by the USMCA. Canada's next step will be to assess the economic impact of these tariffs and decide on a strategy for potential retaliatory measures, a move that could further escalate the trade dispute. The situation highlights the challenge of maintaining stable trade relations when they are intertwined with sensitive geopolitical issues.